Imagine a small, vibrant nation called Oceania, surrounded by the vast blue waters of the Pacific. The people of Oceania thrived on trade, exchanging their world-renowned pearls and tropical fruits for machinery, medicine, and electronics from other countries. But every year, the nation's leaders gathered to review an essential document that told the story of their economic relationship with the rest of the world, the balance of payments, BOP. The balance of payments was like a ledger, recording all financial transactions between Oceania and other nations over a year. It was divided into two main sections: the current account and the capital and financial account. These accounts together offered a comprehensive view of Oceania's economic health. The current account was where the story began. It tracked the flow of goods, services, income, and transfers. Imagine the bustling port of Oceania, where ships loaded with pearls and bananas departed for foreign shores, bringing wealth back to the island. These exports were recorded as credits, reflecting money coming into the nation, but imports were also part of the story. Oceania needed advanced technology and medicine, which it couldn't produce domestically. These imports were recorded as debits, representing money leaving the nation. When the leaders examined the numbers, they noticed a trend. Oceania's imports often outweighed its exports, creating a current account deficit. This deficit wasn't necessarily a bad thing, though. Oceania's people enjoyed the imported goods that improved their quality of life, and the deficit was financed through other means. To understand how the leaders turned to the capital and financial account, the second part of the balance of payments. The capital account tracked transfers of assets like land or large financial gifts between countries, though it was often less significant. The real action happened in the financial account, which recorded investments. Imagine a tech company in a neighboring country investing in a state-of-the-art processing plant in Oceania. This foreign direct investment brought much needed capital and jobs to the island, recorded as a credit in the financial account. Oceania also borrowed from abroad to fund its trade deficit. International banks provided loans, and foreign investors purchased Oceania's government bonds. These inflows were crucial for balancing the books. But the leaders knew that relying too heavily on borrowing could lead to challenges down the road, like increasing debt or dependence on foreign capital. As the years passed, Oceania experienced moments of balance of payments, disequilibrium, when inflows and outflows didn't match. One year, a global economic downturn reduced demand for Oceania's pearls, widening the current account deficit. Another year, a natural disaster destroyed banana crops, cutting into export revenues. Each time, the nation had to adapt. To restore balance, Oceania employed various strategies. Sometimes the central bank used its foreign currency reserves to stabilize the exchange rate, making exports more competitive. Other times, the government implemented policies to encourage domestic industries, reducing reliance on imports. Investments in infrastructure and education also paid off, boosting productivity and export potential. Oceania's leaders also learned the importance of remittances, money sent home by citizens working abroad. Many Oceanians lived in neighboring nations, sending a portion of their earnings back to support their families. These remittances became a vital part of the current account, providing a steady inflow of funds. Over time, Oceania realized that its balance of payments was more than just numbers on a page. It was a story of relationships, resilience, and growth. The BOP reflected the nation's interconnectedness with the world, showcasing both its strengths and vulnerabilities. For instance, when Oceania invested in diversifying its exports, it became less dependent on pearls and bananas. The nation began producing high quality handicrafts and ecotourism experiences, attracting visitors from around the globe. These new revenue streams improved the current account balance while creating jobs and preserving the environment. The story of Oceania mirrors the experiences of real nations. Take the United States, which runs a persistent current account deficit due to its high imports and reliance on foreign investment. Meanwhile, countries like Germany and China often maintain surpluses, exporting more than they import. These patterns reveal the unique roles that nations play in the global economy. In the end, Oceania's leaders understood that the balance of payments was not about achieving a perfect balance. It was about managing relationships and ensuring long term stability. By carefully monitoring their BOP, they could identify opportunities and address challenges, ensuring a prosperous future for their nation. The story of the balance of payments teaches us that every transaction, from buying foreign goods to investing in another country, is part of a larger narrative. It's a reminder that economies, like people, thrive when they connect, collaborate, and adapt to the changing tides of the global marketplace.